Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, the Fed, they're up to the same old shenanigans. They're pulling another one on you. We're going to talk about exactly what that is, why that means probably a lot more inflation, and also why a recession is all but guaranteed. We're going to dive into the charts, so let's get to it.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
Bob, it's funny. They're just when it comes to the Fed, A, they never tell you what's up in reality, and B, nothing new under the sun.
Hey Phil, do you know how you could tell when a Fed member is lying?
Yeah, their lips move.
Exactly. So we're gonna show you guys a couple charts. It'll just make you. It would be funny if it wasn't so sad. But we've been tracking. Everybody looks at like analogies. History rhymes, that kind of a thing. And a lot of people are thinking, are we pacing for the Great Depression? Are we pacing like the 1940s? Are we pacing the 70s? Are we pacing the 2000s? And the analog that seems to be been the closest so far is really looking at 1966. 1966 to 1986 is kind of the analog that's starting to play out here. And we just finished, coming out of an environment where we had fairly benign inflation, and then we had a spike with all the spending they did with the COVID, and now we're hearing, Phil, that everything is now disinflationary, deflationary. But history doesn't work that way. You typically get triple moves in inflation spikes. And if you don't already have the chart up there, if you could throw it up for everybody, we're at a point now where we probably have reached the first bottom in the inflation. And if you just look at what's happening with food prices and with energy prices, it's skyrocketing, and real estate and rents are staying sticky no matter what narratives they try to press in the media. And so we're looking for basically the next 6 to 9 months, we're going to look for a swing up higher in inflation, Phil.
Yeah, I totally agree. And I think, we'll get into, it's funny because it's going to play into, I think, where you go into a recession and then they have to do the same old thing with QE, and that's going to kick inflation up again. And that kind of segues into the next part of the story, which is this other chart here, and that is the Fed's narrative through all this, right? So, okay, we're going to go down. Now, this isn't inflation next week, right? I mean, that chart basically said this is going to play out over the course of a couple of years, and, the yield curve basically has been saying that, potentially we could be bottoming out through 2025. So that kind of plays into that analog from the 70s on inflation spiking back up. And why inflation would spike back up is through things like yield curve control or another round of quantitative easing. And this chart, I think, is hilarious because, the Fed's been out there in force saying soft landing, soft landing, soft landing every week. They got some Fed speaker talking about how they don't think a recession's coming and it's all about the soft landing. Well, if you look back in time, especially like the last couple of times, notably would be the dot-com bust and the great financial crisis, our last two big recessions, that was the same thing. Soft landing headlines. And then that orange line, so that's the white line is the headlines, basically the frequency of the headlines that say something about soft landing. Then you have this orange line, which is the Fed funds rate. And you'll notice, right, as they get to the point or near the point where not only do they stop hiking, but they start getting ready to roll over in cuts. And the only reason why they're doing that is because we're running into a recession, right? This precedes that. So this is the Fed's playbook. They're basically telling you one thing and getting prepared for another. And they try to run this narrative to keep everybody calm. And instead of saying, look, we're coming in for a big recession and there's nothing anybody can do about it, and getting everybody all freaked out. So they never tell you what you need to hear. They're going to tell you what they feel they need to engineer the least destructive path. But what you need to be realizing is that you need to be preparing yourself for what's coming down the pike. And I think this graph here with how they propagate headlines into rate raises, I think it's very obvious to see where this is all going, and plays right into that inflation graph we just showed you guys.
Yeah, and the reason why they do that, guys, is that the Federal Reserve is not your friend. Okay, their bosses are the banks. That's who owns them. You always please your boss. And so what they want to do, they want to fix you while they prepare. And so they can always be in front of you. So the best way for you to be prepared is to see what they're saying and start preparing for the opposite. Always. Always. It's been this way time immemorial, okay? Because they need liquidity to sell. So if they keep you in the market buying, they can sell to you. And look what's happened this time. We've exceeded the soft landing headlines from the 2000 bubble, okay? And things are going to be rolling over pretty hard here. So you got to be really careful. Phil, you're absolutely right. I had you on mute. I was trying to talk. It was pretty funny. But you're absolutely right on the other chart. You don't have to go back to it. Is that once inflation spikes, they know they're going to have to get dovish. You're going to start seeing the yield curve control come in, and they're going to say, to hell with it. We're going to allow inflation to run because the government cannot absorb the interest rates payments out. And that's what's going to spike us. So we're going to have plenty of time here to be long energy, to be long gold, to be long Bitcoin. And right now, energy gets the first pop. And then once they do yield curve control, just start writing checks for your gold and your crypto accounts, because that's where this money is going to just transfer to. And the rest of the equity market's going to suck wind.
Yeah, and I think too that's why when I'm looking at Bitcoin specifically, I think that the halving cycle will be a little bit different this time, because this halving cycle that we go into having in the first quarter of 2024, and then we have typically like a year and a half spike over that. I think it gets elongated, and it looks like that gold chart from the 2000s where you have a multi-year run that's kind of linear, doesn't have that big like 70-80% pullback. Because of this chart here, this inflation chart is going to juice it. And like you said, it's going to be yield curve control, because it's going to be like Japan, right? You cannot afford the debt at those interest rates, and so you have no other choice. Ultimately, it hurts the consumer, but again, if you're smart and you have these hard assets like this that will outpace inflation, you'll do okay. But it's going to suck for a lot of people, unfortunately. So hopefully, people understand what we're saying here and do the right thing with their portfolios and their investments. Yeah,
look, you need to make things happen. Don't let things happen to you. Right. And if we overlay this gold chart on here, you would see this gold really takes off 79.80. Yep. So it's waiting for that yield curve control. There's another chart. I'm going to try to find it, Phil, and if I can, we'll do it as a podcast. But there's another one saying the way our real estate and demographics are laying out, that we're Japan 1981. So you guys do your own homework, or 89. Do your own homework on that, and you can see that that's when Japan started instituting 30, 40 years of yield curve control, and the U.S. has no choice but to do the same thing until they get through the baby boom bust.
Yep. Yeah, I agree. Well, guys, let us know your thoughts, and what do you think about this information, and do you think we're right? You have another opinion on that? We'd love to hear from you. Otherwise, please hit like and subscribe, and check out our specials over at tradegenius.co. And thanks, Bob. We'll see you on tomorrow's episode. Take care, guys. Bye-bye.
Trade Genius.